Peter Schiff, an economist, stockbroker, and financial expert, issues a warning about risky trends in mortgage and refinancing applications that could lead to more severe outcomes in the future. According to Peter Schiff, there is a large housing bubble blown up by artificially low interest rates, and this bubble, which, if it is greater than the one that existed before the 2008 catastrophe, could actually be pretty alarming because the 2008 housing bubble is now paired with a far larger economic bubble, bringing about yet another severe financial disaster. Peter said that the Financial Reserve is still raising interest rates, which is causing the housing bubble to gradually deflate. And because of the apparent decline in housing expenses, some people also assume the CPI will start to decline. Peter emphasized that just because housing costs are falling does not mean that housing prices will follow suit. And he is continuing by saying the price of housing is still rising. What matters is how much it costs to own a home, not whether buying one is more affordable. And those expenses are rising, because even if you pay less, your mortgage payment will still increase. While Peter examined the information on the mortgage applications received, he says the economy is severely affected by the sharp decline in mortgages and refinances. Nobody can refinance their mortgage into a cheaper rate at the moment because everyone has a better rate than what they can get today, since the mortgage interest rate is currently so high compared to where it had previously been, he says. A growing number of people will be hesitant to sell as long as their mortgage rate is low because mortgage rates are expected to climb in the future, and a new mortgage won't be something they can afford. Peter also added that you cannot transfer your mortgage from one house to another, and neither can one person who purchases your house, and neither can the person who purchases your house. They must obtain a completely new mortgage. As a result, they will delay and prolong their stay in their homes for as long as possible because so many individuals have such low mortgage rates. Mortgage interest rates have also grown at their quickest rate ever since 1994, Peter said. And rising mortgage rates have also cut off millions of Americans from a possible source of income. People frequently refinance their mortgages when interest rates fall, but as Peter Schiff noted in a recent podcast, the refi market has already been mostly eliminated by rising interest rates. He claims that refinancing results in lower monthly mortgage payments, which relieves some of the financial strain in addition to providing a lump sum of cash to spend. But as mortgage rates fell in 2019 as a result of the FED's monetary U-turn, it led to a wave of refinancing, and now the refi market has completely collapsed over the past several months. Refinances of mortgages have also decreased by 80% from their peak in March 2020 and by over 70% over the last decade, and therefore mortgage refinancing is no longer available to promote consumer spending. Peter also pointed out the fact that investors are leaving the market. Investor capital flooded into the housing market during the easy money, low interest rate boom that the Federal Reserve established in the wake of the pandemic, but now investors are beginning to flee as a result of the FED's rate increases, which has caused mortgage rates to appear to soar, and it's caused a decrease in housing values. Peter also mentioned that the stock market has also collapsed and that the FED was obliged to stop tightening the money supply the last time market mortgage rates were this high by artificially suppressing interest rates and acquiring massive amounts of mortgage-backed securities. But with this move, the FED blew up this housing bubble. The combination of low mortgage rates and quickly rising home values, according to Peter, can result in the formation of a housing bubble, and now the central bank has punctured that bubble by raising interest rates, saying, "What the FED gives, the FED also takes away." Mortgage rates began to fall in late 2018. When the economy collapsed and the Federal Reserve stopped raising interest rates for the first time since 2008. Rates fell through the floor as a result of the rate cuts and QE infinity initiated by the FED in response to the coronavirus, which occurred as the FED turned back to quantitative easing. Mortgage rates also reached historically low levels after the pandemic, and property values rose sharply. On the first day of the listing, sellers received many bids that were higher than the asking price, but Peter added that in order to counteract growing inflation, the FED started to advocate monetary tightening, which is when mortgage rates experienced the massive rise we are presently witnessing. And so now in 2023, Peter anticipates the housing bubble will keep deflating, and he says we'll have to wait and watch to see how quickly the air comes out and how that affects the overall economy. All of this, therefore, foretells that the mortgage issue will develop into a major problem and that much worse financial crises will occur shortly after as a result of this. Peter ended by saying he doesn't believe that the FED will do anything other than observe how things play out. It's a real problem, so we want to see what you think about the mortgage crisis down below in the comments.